Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host Desmond, and today we're talking about a hot topic in 2025, surging gold prices. Why is the yellow metal glittering brighter than ever? What's driving this rally beyond the headlines? And most importantly, are there trading opportunities for you? Right, let's break it down in the next few minutes. First up, why has demand for gold surged again in 2025? The short answer, uncertainty. Gold thrives when the world feels shaky, and right now, we've got plenty of that. President Trump's tariff policies have rocked global markets, sparking fears of trade wars. His plans for 25% tariffs on steel, aluminum, and imports from countries like China have investors worried about inflation and economic fallout. When inflation looms, gold becomes a go-to hedge, a safe haven that holds value, right, when currencies wobble. Right, central banks are also fueling this fire. In 2024, they bought over 1,000 tons of gold, and with heavy hitters like China's People's Bank adding 15 tons in November and December alone. This trend shows no signs of slowing as nations diversify away from the US dollar amid geopolitical tensions. But tariffs aren't the whole story. Let's look beyond the headlines at other factors driving gold's rise. Geopolitical risks are a big one. Ongoing conflicts in Ukraine and the Middle East, plus tensions in the South China Sea, keep gold's safe haven status in demand. Then, there's the Federal Reserve. With interest rate cuts expected to continue in 2025, the opportunity cost of holding non-yielding gold drops, making it more attractive. A weakening US dollar also plays a role. Gold is priced in dollars, so when the dollar dips, gold gets cheaper for foreign buyers, boosting demand. And don't forget consumer markets like China and India, where jewelry and investment demand remain strong despite high prices. In China, a new pilot program even allows insurance companies to invest in gold, potentially adding billions in demand. So, with gold prices soaring, right, hitting $3,317 88 cents per ounce as of April 17th, 2025. How can traders position themselves in this environment? The good news? Gold's volatility offers opportunities, but you've got to be strategic. For short-term traders, gold futures and CFDs on platforms like CME Group are liquid and responsive to news like tariff announcements or Fed decisions. Now, keep an eye on economic data releases like non-farm payrolls or CPI, which can swing gold prices. Right, for a less hands-on approach, gold ETFs like Spider Gold shares are seeing inflows as rates fall, offering exposure without the hassle of physical bullion. But here's the catch, gold can be volatile. Some analysts, like those at Business Insider, warn of a potential pullback if supply ramps up or economic fears ease, so consider stop-loss orders to manage risk. Long-term investors might see this as a chance to diversify, especially with prices forecast to hit $3,500 or more in the next 18 months. Before you jump in, do your homework. Gold's allure is strong, but it doesn't pay dividends, and prices can dip as fast as they climb. Align your strategy with your risk tolerance and stay updated on global events. Always monitor the dollar's strength and central bank moves. That's all for today's episode. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.